9 a.m. in Beijing and Hong Kong. Welcome to Bloomberg Markets China Open. I'm Yvonne Man. Our top stories this morning. Asian stocks trade cautiously despite Wall Street ending February at fresh highs after the Fed's preferred inflation gauge met expectations. China top leaders pledged to meet economic goals and targets as the National People's Congress gets ready to meet. Investors eyeing more forceful stimulus measures. And China's PMI surveys for February likely to show a slowdown in activity due to disruptions from the Lunar New Year holiday. So that data coming through at the bottom of this hour might be a bit noisy, just given that we have those seasonal distortions with the Lunar New Year holiday. So certainly, is it going to be that market moving is a key question here. But yes, we are basically on the eve, you could say, of MPC. So this is what the setup is looking like. We're pretty flat when it comes to A50 futures here this morning. You take a look at what's going on with markets like Japan. Take a look at that continuing to charge forward in the first trading month of the year, of the third month of the year, I should say. 1% gains to start off the month of March. And take a look when it comes to, Australia is pretty flat here this morning, but we've got PMIs, we got tech stocks in focus, was given some of the JD news, and some data out of Hong Kong as well as Macau later on this afternoon. Flip the boards here. Taiwan, Singapore, Malaysia coming online. There is some focus now on the ringgit. We are on intervention watch after we did see that currency, basically sink to those 6-year lows. So we heard from the Malaysian minister saying the central bank ready to defend the ringgit. State Street says 480 might be that line there for them to step in. Certainly one to watch here this morning. Still seeing some strength, at least when it comes to the ringgit right now. Bonds are doing this. Of course, that PC inflation, increasing the most in a year, but it met expectations. So in some ways, that did ease some fears out there that perhaps, this whole higher for longer scenario that we were dealing with in the bond market might be a little bit overdone now. You take a look at how your curves are looking like here. We are seeing in the Asia session yields are ticking slightly higher, but they did actually see bonds rally overnight here. So 426 for your 10-year. We're also taking a look at global bonds here in the region. But you're looking at dollar yen. That's the one to watch still. So you're getting more signs that maybe a rate hike is getting closer out of the BOJ. We'll see, right? 150.29 for dollar yen. That they were the standout, though, in the midst of G10. Really just still seeing that bit of strength there this morning. But, we're basically looking at FX is pretty slow going. 720 for dollar China. And commodities are doing this. Oil, certainly, we talked about, we're eking out a second month of gains. Iron ore is near that 4-month low. I think we're at 3-week highs when it comes to gold. And Bitcoin, that continues to be a story. It's steady now, though. But we're talking about some of these record inflows into that BlackRock iShares Trust. $612 million in Wednesday. That's the biggest one-session haul that we've seen there, and really breaking records continually here today, this week, I should say. All right, take a look when it comes to your agenda. Obviously, when it comes to those PMIs, you also have home sales that we need to deal with here. So certainly the top 100 developers still seeing a bit of a drought there when it comes to how home purchases are looking like here today. You have the Politburo support measures there. They're vowing to keep with some of these growth targets. Northbound flows have been pretty interesting. We basically snapped out of 6 months of outflows here. And tech stocks, we talked about the JD story. And of course, we have retail sales and Macau GDP and casino revenue to wrap up your trading week here today. Let's get to our top story. China's top leadership has pledged to meet economic targets for the year while avoiding risks and maintaining social stability. For more, let's bring in Bloomberg's China economy editor Jill Desus to join us through what we heard from that meeting. And this is the one thing to watch, right? That growth target next week.
Yes. Really everything, Yvonne, kicks off on Tuesday. We'll kind of see a bunch of different news out of this big MPC meeting. That economic growth thing is that's really the one to watch. I think at this point, a lot of the economists that we're talking to are saying they think that China is going to target growth of around 5% yet again for 2024. So you will recall that was the target that they set for 2023, although this year that would be much more more ambitious just because you're dealing with a higher base of comparison from the previous year. And so what that means, though, is that investors are going to be looking for, is there going to be any additional stimulus? What kind of policy support are we going to see through the rest of the year? This will be an opportunity for us to really kind of get an idea of what that may look like. I'm also looking for what they're setting out in terms of any budget revisions for the year. You'll recall, again, last year we saw some mid-year budget revisions that were really interesting as we got a bit more fiscal stimulus to work with. Is that going to be the case this time around? We'll have to see. How
high of a bar is it now to meet those expectations at MPC?
Yeah, I think that honestly, at this point, I wouldn't really expect a ton of extra stimulus out of the Chinese government right now. I mean, that was really something that the Premier Li Qiang has already front-ran a couple of different times, including most significantly at Davos, Switzerland in January, where he said, look, we achieved our growth targets for 2023 without resorting to any kind of massive stimulus. So I wouldn't really expect that again this time around. But I will mention, though, that as we've looked at a lot of the issues within the economy, look at the stock market, for example, China has taken some pretty significant steps there, replacing the market regulator, those kinds of things. So it's not that nothing's on the table. It's just that, we won't see anything huge.
Yeah, we have those PMI numbers coming through here. I mean, we talked about in the break. It's a bit of a noisy print this time around.
Yeah, this is a really annoying one for March. I mean, look, or rather for February, because look, I mean, ultimately, we're dealing with the Lunar New Year period. So we've got this massive 8-day holiday right in the middle of this month that we have to contend with here. So I think a lot of economists right now are expecting another contraction in that factory PMI number, and then an expansion in the services PMI, although maybe around the same levels as we saw the prior month. I think that at this point we just kind of have to accept that whatever we're getting for February really isn't going to tell us a ton about the state of the economy. We really want to wait until we get those more comprehensive numbers for January and February in the middle of this month. So around like March 15th or so, we'll actually see something that gives us more comprehensive data for the period that we've just experienced.
All right, Jill. Thank you. Jill Deese is there, our China economy editor, on what to expect, not just from the MPC, but of course, those data numbers coming through there to Bloomberg in just about 24 minutes away. Let's get to Paul Dobson, our executive editor for Asia Markets. And Paul, as we count down to MPC, I mean, what should we be watching out for the most? I mean, what do you think could actually appease market participants next week?
Well, I mean, I'm not sure whether it will be possible to deliver everything that the market is hoping for. I mean, there's a kind of short-term and long-term kind of things that really are needed to kind of give the equities market that sort of confidence and lift for the gains that we've seen recently to be sustained. What I mean is, the market would really like to see some comprehensive policy measures on the economy, things that would help the property market in particular, to give that sense of lift and to give that confidence. But that's really the thing that's lacking, and the thing that's harder for policymakers to deliver is that kind of that confidence itself, to get the consumer spending again, to get liquidity moving again in the property market. And that's something that takes time to build that trust again. I mean, if you look at the bond markets, at the fixed income side in China at the moment, people are just, piling in. The interest rates are falling and falling. People are betting that interest rates are going to be lower for longer, and that this disinflationary mindset that we've got now is going to continue. So it's kind of breaking that cycle and finding a way to unhook it that the market really needs. But I'm not sure whether we will be able to get that from policymakers in these meetings.
And how important is it then for policymakers to continue this sort of support that we're seeing across these markets, right? Because I don't think the earnings story is turning around anytime soon in China. Are we likely to see more support measures into capital markets?
I think that momentum, that drip that we've seen, not anything massive, but incremental measures is certainly, the expectation, the thing that we've got used to now. But I would say that probably the rebound that we've seen in equities market has been more about the sticks than the carrots. What do I mean? I mean, the measures to clamp down on some of the short selling, the efforts to kind of rein in the speculative trades by the quants, has forced people out of position expectations rather than, the promise of a booming economy being the sucking people back in or making people want to buy. Also, the market is just incredibly cheap, so there is that at least going for it at these kinds of levels. But it's not, I don't think, the hope and the excitement about the policy that's really driving the gains at the moment.
And of course, we did hear from some Fed officials. They're still not in the rush to cut rates, it seems, right now, Paul. I want to play some of that sound that we got overnight from some of these speakers. Take a listen.
We want to avoid holding on all the way to 2%. They're putting policy very tight and then cause an unnecessary downturn. We are agile, and we're sitting in what I call the ready position. We are ready to make moves and adjust as the data demand us to do. And I think right now the economy and policy are in a good place to do that.
I'm of a view that it'll probably be appropriate if things go the way I expect to see us to start to reduce rates in the summertime.
All right. So Bostic says maybe they could reduce rates in the summer. I'm just wondering, that PCE inflation report was quite important for the bond market. It looks like we saw it in line with estimates, which did ease some fears out there that perhaps inflation is not reviving itself in a big way. But I'm just wondering, what is that bias in the bond market now? Is it for yields to tick higher, or can we actually continue with this rally?
Yeah, it's a good question, Yvonne, isn't it? Yields are still quite close to this year's highs, and it's all about pricing out those expectations for Fed cuts, particularly pushing back on when the first one comes, but also the pace that the Fed will move at after that and how many we can expect to see by the end of this year. I think the PCE was so well telegraphed. Everybody knew that it was going to show that increase, and it came out completely in line with expectations. So it was kind of already priced in, and the market was relieved that it wasn't any worse than what was delivered. So in that respect, it's kind of at least doing what people are expecting. But I think, Mary Daly is a good one to sort of latch onto and to follow what she says very carefully. She's talking about data dependency in that clip. It's kind of where the Fed is. They're all singing from the same hymn sheet, all talking about cuts later in the year, depending on the data. But really, they need to see that inflation coming back out of the market over the next few months in order to be confident that it's all right to start cutting. And by the way, the economy is doing fine in the meantime, and the markets are doing pretty fine in the meantime as well.
Paul, thank you. Paul Dobson there. Obviously, it has been a decent month, really, when it comes to Chinese markets. Of course, risk assets here today. Still ahead, we're going to talk a little bit more about what's going on with China and how, as we count down to the National People's Congress, we're going to have RBC Wealth Management Asia Senior Investment Strategist Jasmine Duan joining us next. And we're counting down the open of trade in Shanghai, Shenzhen, and Hong Kong. We are watching very closely. A50 futures are down about 1/3%, but Asian stocks, we are still on track for a 6 straight week of gains. Happy Friday. All right, your RMB fix just crossing your Bloomberg here this morning, and I'm guessing it's no surprises here when it comes to that policy support that we're seeing. 710.59. The estimate was for a 719 print, so certainly that is a stronger fix from the central bank. 720.86. We've been seeing a pretty steady renminbi kind of leading up to this MPC, so certainly that's one to watch afterwards here. But we're watching some of the technicals. Obviously, we talked about the milestones that we're seeing when it comes to HSI, HSCEI, CSI 300. We're on track for the best month, basically, in 13. But the technicals suggest maybe it's going to be hard, right? The HSCEI has basically been hitting its head on that 100-day moving average for 3 times now. Is it third time lucky? Can we break above that major resistance? That's certainly one to watch. So let's bring in Jasmine Duan, Senior Investment Strategist at RBC Wealth Management Asia. It's been a good rally for Chinese equities this month. I'm just wondering, how important is this MPC to you, and how do you position around it?
Well, right now the whole market is watching at the MPC, and we think the MPC will will confirm policy continuity, and they will reaffirm that they will have reactive easing measures and incremental policy easing. So the key to watch is really the growth target for this year, and we think that they are going to still set the growth target at around 5%. And also the key thing to watch will be the fiscal package and how the government is going to set their official fiscal deficit target this year. So the market has increased their expectation from around 3% of GDP to 3.5% now. So that's something to look for.
Usually MPCs, you do see China stocks tend to rise afterwards. If I see 5%, if I see 3.5% for that budget deficit, I mean, is that going to be enough to keep this rally going, you think?
Well, we think all these market supporting measures recently have helped to stabilize the sentiment. However, it may not be enough to support a sustainable rally. And we think the long-term growth outlook and also the earnings outlook is what investors are truly concerned about. And right now, China is really at a transitory stage. So in the past 4 decades, they can only consider about economic development. But right now, they have a lot more to consider, including national security, food security, and tax self-sufficiency. So the situation has become a lot more complicated. And at this point, we may see the market just range-bounding.
So what have you been recommending for this month alone? I mean, it's been a bit of momentum behind this. Are there sectors that you think are going to be more important to watch during the MPC that could benefit from this meeting?
Yeah. At RBC Wealth Management, we still maintain our strategy to pick alpha, and we think sector allocation and stock pick is vital here. And we continue to like the SOE reform theme, and we think it will be a medium and long-term theme to look at. And also to own some high dividend new stock at this level looks attractive to us. And we like the energy, financial, and China telecom sectors.
Okay, I want to switch gears, talk a little bit more about this inflation print that we got out of the U.S. as well. I mean, I think it was no surprise that it was rising the most in a year, just given how hot that CPI print was just a week or two ago. You know, this equity market has basically just gone a different direction and really kind of, you know, not avoiding or actually ignoring this whole Fed narrative. Do you think that, you know, U.S. stocks are still kind of the place to be right now?
Yeah, right now at RBC Wealth Management, we still maintain a neutral weight at U.S. equity. We think we expect the market to have a healthy pullback at this level after a very strong rally since November last year. And right now, investors' positioning in the market seems to be elevated. Also, at this level, the deflationary progress seems to be taking a step backward. However, we think many of the factors may turn out to be one-off, because think about usually in January, companies increase their prices, and over the past 30 years, if we look at the data, January typically to be the month to have the largest inflation coming in. So we still think soft landing is our base case scenario, but we cannot rule out a possibility of recession. So we'll still maintain a defensive bias, and healthcare sector would be a place to be in our view.
There's been, I mean, everyone thought this, you know, bond steepeners, this rally was going to really take place in 2024, and it hasn't quite played out the way that people thought maybe a few months ago. And in fact, equities have actually outperformed bonds year to date. Yeah. Can that outperformance continue, you think?
Yeah, we think this year the fixed income, we are having an overweight, and we think there is it is a good opportunity to lock in yields at this level. And currently, we still expect the Fed rate cut to happen in June this year, and we think the deflationary progress is going to be back on path in summer, because if we look at some of the indicators, for example, the shipping numbers, the shipping cost is cooling down again.
All right, Jasmine, great stuff. Jasmine Duan, Senior Investment Strategist at RBC Wealth Management Asia. We're checking the tech space very closely here, just given the news when it comes to JD. So they're cutting their cloud prices and really kind of following what we heard from Alibaba yesterday as well. So we are seeing the likes of JD are slightly down, but Alibaba, Tencent, and Baidu are all down about 1%. NetEase is the one that we're really focusing on this hour. So profit actually jumped, but the gaming sales, that was a missing expectations there. The stock is down close to 4% in the pre-market. Plenty more ahead. This is Bloomberg. Some of the top corporate stories that we're following for you today. Apple resellers in China are slashing the price of iPhone 15 models as demand continues to slump. iPhone 15 Pro Max handsets are now selling for $180 less than their original cost on Alibaba's Tmall. That's a steeper drop than the $120 discount Apple offered last year. The iPhone 15 has lagged in sales in China amid an economic slowdown. Shares of New York Community Bancorp plunged in late trade after the lender took a $2.4 billion hit to earnings. It's also identified weaknesses with its loan review process, reigniting a drama that erupted at the end of January when it slashed its dividend and stockpiled cash to cover troubled debt. The bank has named new leadership to navigate the turmoil, with Alessandro Danello taking over as CEO. Take a look when it comes to futures here. We're seeing a bit of a wiggle and wobbles here when it comes to the Hang Seng. We're down about 0.7% at the pre-market. HS Tech seems to be dragging things. Obviously, we talk about those NetEase earnings. China 10-year yield at 235, not going to anywhere. And we're watching very closely these northbound flows. So when it came to just today, yesterday, right, we saw the biggest inflow year to date in northbound channel yesterday. We're talking about 16 billion renminbi, which is the biggest one-day inflow we've seen since July. You take a look at it at a bigger lens and zoom out. We basically have seen foreign investors with those northbound flows snapping out of 6 months of outflows. Is this sustainable is the question. And what are they buying, right? You take a look at what investors are snapping into, or at least getting into, I should say. And it's really mostly the financials. That dominates a lot of the flows out there. Maotai certainly is an outperformer, but also, we take a look at Ping An, ICBC. So it's industrials, it's the liquor makers, it's the banks that really where you're seeing a lot more appetite for this month in January. In terms of analyst actions to tell you about, there's been some talks when it comes to New World Development that was been cut to underperform at Jefferies after their earnings. Goldman had an interesting take on the Hong Kong developers. They prefer retail over residential and office within their coverage of property stocks. So Wharf Real Estate, that's been raised to a buy. ASMPT, chip makers there in focus, raised to a buy at Berenberg with a price target of 130 Hong Kong dollars. Some stocks to watch. We talked about JD.com with what we've been seeing and these, what you can call it now, maybe price wars in the cloud space as well. We're down about 4% for NetEase. There was interesting lines here crossing the U.S. investigating Chinese EVs when it comes to national security risks, but we are seeing the EVs up this morning. The open is next. You're watching Bloomberg Markets China Open. PMI data coming out any second now. And we talk about this is sort of that noisy print because it does mark that Chinese New Year holiday. So certainly let's not, take it with a grain of salt. And whether it does move markets is a big question as well. Unlikely because there's still all that anticipation when it comes to NPC next week here for any signs of what policymakers are going to do to continue this rescue of the economy, of markets, the like. So everything from the GDP target, fiscal targets, any signs of support into the property market is certainly going to be in focus for investors here today. Equities do tend to do well after MPC. We'll see if this time is the same, just given all the, it's a very high bar to deliver what the market is yearning for, it seems. But certainly we continue to see the Hang Seng. We're down about 0.7%, I should say, but we're still on course for one of the best months for February for Chinese equities we've seen since January 2023, I believe. Hang Seng, though, is down about 1%. That data is out here right now. So 49.1, that's slightly better than expectations for manufacturing PMI. And 51.4, so at least for non-manufacturing PMI, that was a sizable beat there. This estimate was for a 50.7 print here. But yes, you have to factor in that, Chinese markets, and it was holidays there. It was an 8-day holiday. So certainly that is a bit more muddled in terms of what this means, this data this time around. In terms of some movers that we're watching very closely here as well, we focus on NetEase, given those earnings that did disappoint the market overnight in the U.S. We're watching very closely, right? Because that PCE inflation out of the U.S. basically sent U.S. stocks surging to new records. The bond markets are also rallied. There's been some relief, but China is not quite seeing that here today. We're down about 0.8% for the Hang Seng now. Take a look at when it comes to individual moves that we're seeing, it is going to be about the tech space here. So we had the JD.com slashing prices when it comes to cloud, following a day after what we heard from Alibaba with those news as well. So certainly that's one to watch. All right, let's focus on the PMI data. Let's bring in Becky Liu, head of China macro strategy at Standard Chartered Bank. So should we make much of this data, Becky?
This is a good set of data. So both manufacturing and services PMI have been beating expectation. I think it's a reflection of the strong tourism data that we have been seeing in the Lunar New Year holidays. And what's also good is that we had a period of very soft PMI and macro data in the fourth quarter of last year, and we started to see some recovery in January. So this would be a continuation into the January momentum, and hopefully we will see the momentum slightly picking up further for activities, especially construction activities, to start in a more forceful way after the Lunar New Year holidays. We're also seeing some signs of turning around in terms of, for example, export orders, which could be part of the reason supporting the manufacturing PMI, and obviously the tourism data as well.
Does that change in any way what policymakers are thinking about when it comes to stimulus measures now, if the data is really, according to you, starting to turn?
Well, the turn has been very modest, and it's from a very low level. We don't think it's going to make any difference when it comes to overall policy making. So if we look at the GDP target now, I think the consensus is 5.0% or around 5% of growth this year, which will require a step up of policies, because that would mean the two-year average of 2023 and 24 GDP growth would be 5% if we do achieve around 5% this year versus 4% a year ago. So that needs both fiscal and monetary policy to step up in a meaningful way from last year.
You're still expecting, though, that this fiscal target could be about 3% of GDP. I've seen estimates out there that go from 3.5% to all the way to close to 4%. Why such a low number?
The overall fiscal impulse, in our view, is going to accelerate. But why we are only looking for 3.0% of official budget deficit is because they just increased the budget deficit by 0.8% towards the end of 2023. And the bulk of those bond issues only completed last December. So those money actually were just started to be used. And the 0.8% increment last year would de facto should be this year's budget deficit. And therefore, we think they might want to set a conservative target. But at the same time, we do expect special bond issuance, not only this year, but probably for multiple years ahead to support infrastructure expenditures. And special bond, by the current definition, does not really fall into the official budget deficit, and therefore it doesn't impact the 3%.
I see. Okay. How do I position around FX, around rates leading up to this MPC? I mean, obviously, when it comes to Chinese CGBs, this rally, how much further can yields actually head lower?
We still like both flattening of the overall yield curve for China rates in general. We think the tendency is very clear. Especially the PBOC have more freedom to cut rates this year, and we also expect them to be expanding the size of the balance sheet quite materially to support credit lending and so on. So overall, we think China will go through a very lengthy but still relatively slow pace of rate cut, and that will lead to the further decline of bond yields. And for the very back end of the curve, there's also other reasons, especially very weak growth of mortgage loans, if not negative growth already, and the cut of the long end of the curve, the LPR.
What if the Fed cuts rates starting the summer then? I mean, could this divergence actually narrow quite a bit in the back half of the year?
We think if the Fed start to cut, the PBOC will follow almost immediately to cut. Because China's fundamental is calling for pretty substantial rate cuts from here, because real rate is by far too high. It's still close to 4%. It's the highest in the world, almost the highest by China's own historical standard. So there are every single need to cut. But what has been slowing them down has been, one, the desire to keep CNY very stable, and second, they want to focus a bit more on the real estate sector, because mortgage loan is the part of credit that's been coming down the fastest. So we think they, like before the Fed cuts, they could continue to do this asymmetric LPR cut, lowering mortgage rates even further. But once the Fed is cutting, the PBOC would be cutting all the rates almost immediately.
What does that mean for renminbi? Do we see room for further depreciation then in the currency?
Based on seasonality analysis, there would be greater depreciation pressure getting into the second quarter, simply because of dividend payment. But we have also seen the PBOC started managing the FX much earlier than expected at a level that's also lower than expected.
I mean, that fix has been solid at 710 for weeks now.
Exactly.
Yeah.
So that's showing a very clear signal to the market that they do not want the currency to weaken. One of the biggest background this year is that we are going through a historic election year globally. And that means it's very easy for trade protectionism to come back. So from China's perspective, they'd rather slightly sacrifice some of the export momentum, or the trade cycle has already turned, so export will still be okay. But in response to a slightly less aggressive imposition of tariff or even import quotas.
Yeah, that's if we do see a Trump 2.0, I'm guessing, is what you're saying. We're at 720 now for dollar China. I mean, what sort of highs are you looking at that we could retest?
We think we could retest the high last year, like 730, 735 kind of range, but not much higher from here. And in general, it would be easier to defend the CNY this year compared with last year. At the end of the day, we are seeing a complete turnaround of portfolio flows, especially for bonds. For example, over the last 3 months, we have seen foreign inflows back to China's onshore bond market, totaling over 700 billion CNY. That's close to 100 billion in US dollar terms. And the bulk of those are due to arbitrage. And we still see the room of arbitrage continuing, likely to last throughout the entire first half. So that will also be supporting the CNY strength as well.
I was going to ask you, just given what we suspect is the national team, buying up these ETFs, and they're in some ways is stabilizing the equity market. I mean, we're talking about a really good February for Chinese stocks for the first time in a long time. I'm just wondering, does that risk does it have a risk on the bond market anyway, given that all that state support seems to be really focused on equities right now?
It does. In our view, it does. Not only because of the very decisive support to the equity market, but also because of market positioning. It's going to make some of the very long-dated bonds a bit more vulnerable at the current level. And in the second quarter, especially after the MPC, we might see stronger primary supply as well. So if that leads to a correction, which is our current base case, for example, for the back end of the yield curve to rebound by 10-15 basis points, we see that as a good opportunity to re-enter into the market, because in the medium to long term, we still see yields getting further lower from here. So the risk is more on the short term.
I was going to ask you about the property sector as well. I mean, we haven't really touched about that, but it's interesting. We saw that the new home sales data of 100 biggest real estate companies, that some of these prelim numbers, let's flash it here right now. I mean, we basically continue to see this slump persist quite a bit, sliding 60% in terms of the value of new home sales from a year earlier. When do we see a let up in this? Is there a floor that you're projecting right now?
We expect home sales to stay relatively weak for an extended period of time. Throughout all the other markets experience, none of the markets able to achieve a complete stabilization of the real estate sector after a major correction in a matter of quarters. It has to be a multi-year process. And take Hong Kong as an example. Between 1998 to 2003, average Hong Kong home price was down by 65%. So that's an aggressive correction in a free market. So if your price correction is being partly managed, then the fall would last for longer. And from the buyer's perspective, they would feel price may not be at the equilibrium level yet, and they will only wait until later. So we are not really looking for a recovery of home sales data in China, but we do expect the government's policies, especially the 3 projects, to be partly offsetting such weakness, especially when it comes to construction activities and the utilization of the overcapacity there.
Becky, great stuff, as usual. Becky Liu, the head of China macro strategy at Standard Chartered Bank. Just to recap, of course, those PMI numbers better than expected for manufacturing and non-manufacturing. We have some Fed lines coming through when it comes to New York Fed President John Williams. He's speaking in a fireside chat this morning, or perhaps evening where he is. He's talking about there's don't need to tighten monetary policy further. That's the only line that we're getting so far. But basically, as we were talking to Paul Dobson about, it's the same hymn sheet that all these Fed officials are speaking at right now. I take the U.S. Treasuries, though, after this rally that we saw overnight on the back of that PCE data, we are seeing yields ticking up just slightly higher in the Asia session here, up 1 basis points for the short end. China markets are doing this, so onshore looking a little bit different than offshore here this morning, and you're seeing CSI 300 down up about 0.1%. Hang Seng, though, we trimmed some of the initial losses at the open at just about 10 minutes in, so maybe this PMI data did help in terms of being a buffer there and offset some of the weakness that we've seen. But we'll see how this plays out, right? All right, NetEase, still a down arrow story, though, on the back of those disappointing earnings. We got plenty more ahead. This is Bloomberg. All right, we're watching very closely the MPC and really that growth target and what this all means. We did report earlier our BE economists really talking about, China top leaders have pledged to meet those economic targets as a 24-member Politburo met ahead of the next week's MPC. Our chief North Asia correspondent, Stephen Engel, looks at the many challenges faced by lawmakers gathering in Beijing.
The National People's Congress, or NPC, is China's annual session of parliament, convened usually every spring in the Great Hall of the People next to Tiananmen Square in central Beijing. Essentially, the NPC sets the political agenda for the year ahead, when the nearly 3,000 delegates from around the country get their marching orders on day one in the form of a lengthy work report from Premier Li Qiang. While regarded as the highest organ of state power, the NPC nevertheless operates under the direction of the Communist Party of China. The NPC, by design, legislates and executes the directives of the party. The roughly two-week affair is colloquially known as Lianghui, meaning the two sessions, as the NPC is preceded by a gathering of the Chinese People's Political Consultative Conference, or CPPCC, an advisory body supposedly representing views from the broader society and business community. Even though party membership is not required to be in the CPPCC, it is nevertheless directly supervised by the Communist Party.
Our chief North Asia correspondent, Stephen Engel, there with that preview. Let's bring in Einar Tangen now, senior fellow at the Taihe Institute, a Chinese think tank based in Beijing. Einar, always great to have you, of course, as we count down to MPC. What's going to be the message, do you think, that's going to come out of this, in particular when it comes to that work report from the premier?
Well, you're not going to see a lot of change from the Central Economic Work Conference priorities that were set back in December. That was the 11th and 12th of December. Basically, they're thinking about how they can deal with a whole set of issues. They had a fairly successful year. They're looking forward to how they're going to do a lot of things, especially attracting foreign direct investment, getting employment numbers up. And they have a whole bunch of processes, things that they want to do in this coming year, which they think is going to address this.
Will it be enough to restore confidence back into not just these Chinese markets, but really on the overall trajectory of this economy now, you think?
Well, from Beijing's point of view, this idea of the China collapse is a little bit oversold. I think a large part of it is gaslighting. The fact is that China's growth last year exceeded expectations, and this year will exceed by 3 to 4 times, depending whether you're talking about Europe or the United States. Japan's in recession. They really see themselves as leading the economic charge, not falling behind, and I think the numbers indicate that. Now, domestically, people have gotten used to, over the years, high growth, and it is more difficult. Competitive behaviors leaders are pushing a lot of Chinese firms overseas where they're looking for markets. There's a lot of excess capacity, and they're trying to push that in new directions at the same time as the government is trying to encourage industry to be much more efficient. China has 12 times the number of robots being put in place as the United States, and it leads the world. Almost half of all the industrial robots that have been put in production the last few years have been in China. This combined with the digital economy, they're trying to push this idea that China can be more competitive by advancing the technology, this digital economy, better logistics, etc. So they think they have a game plan. Let's see how it works.
We're also marking, of course, President Xi Jinping, and basically, he's been elected to serve a third term, which is unprecedented. I'm just wondering, in terms of, there's been signs, Einar, of maybe growing angst out there, whether you're seeing it in the form of labor disputes or stemming from this real estate crisis, or even just, what we've been hearing on Weibo as well. To what extent do you think that poses a threat to Xi Jinping? What ramification does it have on the president?
Well, obviously, during economic downturns, there are always dissatisfaction. You see that clearly in Europe, America, almost everywhere around the world. The collapse in demand that is being, going through the system affects everybody, including China. China is trying to make it up through this idea of encouraging domestic spending. It seems like they're getting on track there. The latest numbers that came out of the Spring Festival, up 9% in terms of expenditure, and that's versus 2019, the visa-free policy. So they don't really see this as the way that people outside China do. And I think a large part of that is this kind of isolation between the mainland and the rest of the world. There is, as I said, a lot of restlessness, especially concerns about the real estate market. People are looking to the government to solve the problems, but the government can only go so far. They can't fight the international pressures that are being put by the United States in terms of, embargoing technology, investment. These areas, they cannot fight the amount of demand that is decreasing from international markets. But they have been pushing things like RCEP, BRICS Plus, AIIB, right. Asian Infrastructure Investment Bank. So they have, as I said, a game plan. They don't see it the way people outside. Is there angst in the market? Absolutely, but not the same level as you would get it, let's say, in the United States right now.
I know you mentioned Xi has significant challenges but limited time. Are those challenges mostly focused, you think, in the domestic side of things or more internationally now?
Well, I think they're balanced. I mean, internally, he has to try to push this new growth mechanism, which is to rely more on consumption-led growth as opposed to investment-led growth. Internationally, he's dealing with the geopolitical issues that the U.S. is putting in there, and in addition to the conflicts and all the other logistics bottlenecks that are being caused by these conflicts. China's trying to pour oil on the water, get peace going. Very, very difficult, especially in Ukraine and Gaza. So, he has a lot of stuff on his plate. So far, he's been able to manage it. Over the last 10 years, things have continued to grow in a different direction. China sees themselves not as following the U.S. or Western model of development, but their own model. And, truthfully, look at the numbers. Okay. Been very successful.
Einar, thank you so much for joining us. Einar Tangen, their senior fellow at Taihe Institute, joining us out of Beijing. We got some more data coming through here when it comes to those PMI numbers. These are the Caixin private gauge, that manufacturing number coming at 50.9, so also beating expectations. So across the board, we've seen a beat when it comes to that PMI print, whether it's the official or when it comes to the private gauge here as well. All right. Markets, though, we're seeing the CSI 300 turning negative. Hang Seng, though, trimming some of the initial losses here, but we are seeing a down arrow story as we wrap up a pretty stellar month when it comes to Chinese equities. Plenty more ahead. This is Bloomberg.
One of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We would be Ukraine's biggest airline the week after they tell us it's safe to go back in there, because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think, within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment, cost agreement, on which we could lead the charge of air travel into a post-war Ukrainian recovery.
All right, just want to recap the data that we got here in this hour. So basically, and with the synopsis here, it was a beat on all fronts, a 49.1 print when it comes to manufacturing PMI. But just, yeah, there's a bit of that whole seasonal effect with the Lunar New Year that you have to contend with this data. But nevertheless, you are actually seeing that help markets lift a little bit when it comes to what we're seeing in the Hang Seng. We're trimming some of the losses, but CSI 300, keep in mind, we have reversed the initial gains here right now. Dollar China's at 721. So it's a little bit on the weaker side here today. But yes, we talked about, though, we're still on track for equities to do quite well for February. You take a look at what it comes to what's been going on, and obviously it's the PCE inflation out of the U.S. that's really kind of leading, stocks and bonds to rally here. You're not quite seeing that in the Asia session. We're quite mixed, but yes, we're still looking at that MPC and a lot that's hanging for next week as well. So maybe that's why we're seeing a bit of a pause here on this equity rally until we get more from the MPC. And of course, it's a goodbye or a wrap when it comes to the China Open. We're not done yet, though. Before starting next week, we're launching a new program. If you haven't seen it on Twitter yet, The China Show with David Ingles and yours truly. We're going to be giving you and being that definitive source for news and analysis on Asia's largest economy. We're talking politics, policy to tech and trends. Get ready for unique insights, in-depth discussions with the newsmakers who matter. It's a 2-hour show now. The China Show premieres Monday at 9 a.m. in Hong Kong as we begin a busy week for China with the 2 sessions. That's it from us here at Bloomberg Markets China Open. Bloomberg Markets Asia is next.